If you or someone in your family owns a home and is over 62, there's a financial tool sitting in that property that most people either misunderstand, ignore, or dismiss before they ever actually look into it. It's called a reverse mortgage, and the questions I get asked about it follow the same pattern every time. People want to know if a reverse mortgage means giving up the home, what happens to their spouse, whether their kids lose what would be their inheritance, and whether the whole thing is some kind of trap. Those are fair questions that deserve clear answers. So that's what this video is going to give you. I'm going to walk you through the most common questions people have about reverse mortgages, starting from the very beginning. Before getting into the questions, it helps to have a clear picture of what a reverse mortgage actually is, because a lot of the confusion people have comes from not having that foundation. A reverse mortgage is a loan available to homeowners who are 62 years or older that lets them borrow against the equity that they've built up into the home. Unlike a traditional mortgage where you make monthly payments to the lender, with a reverse mortgage, the loan balance actually grows over time because interest and fees are added to it each month. You do not make monthly mortgage payments. The loan does not have to be repaid until the last borrower moves out of the home, sells the property, or passes away. Most reverse mortgages today are home equity conversion mortgages, or HECMs, which are federally insured through HUD's Federal Housing Administration. That federal insurance matters because it creates specific protections for borrowers that we'll come back to throughout this video. One distinction worth making early is that HECMs are the most common type, but there's also proprietary reverse mortgages, sometimes called private reverse mortgages, that are not federally insured and are typically designed for borrowers with higher home values than those covered under HUD's program. Everything discussed in this video applies specifically to HECMs unless otherwise noted. The first thing most people ask is, will taking out a reverse mortgage mean signing their home over to the bank? And it does not. The reverse mortgage is a loan secured by the property, not a transfer of ownership. Your name stays on the title. What that means in practice is that the same responsibilities you had before still apply. You must continue to pay your property taxes and homeowners insurance on time, keep the home in reasonably good condition, and continue to live in the home as your primary residence. Those three things are the core obligation that keep a reverse mortgage in good standing, and failing to meet any of them can trigger a default, which is exactly why understanding them matters before deciding whether this tool fits your situation. Since the home has to remain your primary residence, the natural follow-up question is, what counts as a primary residence, and what happens if you need to be away for an extended period? The home must be where you spend the majority of your year, and you can only have one primary residence at a time. So if you're away for more than 2 months, but less than 6, HUD guidelines indicate that you should notify your lender so that they know you still occupy the property. If you're away for more than 6 months for non-medical reasons, the home is no longer considered your primary residence and the loan becomes due and payable. Anyone else living in the home at that point would need to move out unless they were able to repay the loan themselves. There's a separate rule for medical situations. If you move into a healthcare facility, like a hospital, nursing home, rehab center, or assisted living, you have up to 12 consecutive months before the occupancy requirement triggers the loan. After that 12-month mark, without a co-borrower remaining in the home, the loan must be repaid, and anyone living in there would need to move out unless they can repay the loan or qualify as an eligible non-borrowing spouse. If there's a co-borrower living in the home and you permanently move out for any reason, the co-borrower may continue to live there and receive loan payments as long as they continue to meet all the reverse mortgage requirements. Once a year, your lender will send you an occupancy certification, usually a postcard, that you need to sign in return. So if your spouse is designated as an eligible non-borrowing spouse in the loan documents, that certification will also require you to confirm that you're still married and that your spouse continues to live in the home as their primary residence. It's a simple step, but missing it can cause unnecessary problems, so it's worth knowing it's coming and responding to it immediately. One of the most common misconceptions about reverse mortgages is once the monthly mortgage payment goes away, so do the ongoing financial obligations. But that's not how it works. Even though you're not making a mortgage payment, you're still responsible for property taxes, homeowners insurance, and flood insurance if applicable, HOA fees, condo fees, ground rent, and any other kind of special assessments. This is where a lot of reverse mortgage defaults actually happen, and it's one of the most important things to understand before moving forward. How those charges are handled depends in part on when the loan was originated. For loans made before April 27th of 2015, borrowers could request that the lender pay property taxes and homeowners insurance directly from the loan funds, but it wasn't required. So in most cases, borrowers under those older loans need to budget on their own each year to make sure that those charges are paid on time. For loans made after April 27, 2015, lenders evaluate your ability to pay those ongoing charges before approving the loan at all. So if the lender determines that you have sufficient resources, you can choose to pay the charges directly or have the servicer pay them from your loan funds. If the lender determines there's a concern, they may require a portion of your loan proceeds to be set aside in a reserve specifically designed to cover taxes and insurance. One thing that reserve does not cover is everything else. Condo fees, HOA fees, and ground rent are still your responsibility, regardless of whether a reserve was established or not. If that reserve runs out or if you fall behind on charges the reserve doesn't cover, the loan can go into a default. There are also options available to help manage property taxes specifically. So some states offer tax relief programs for older homeowners, and if your state has a senior property tax exemption, you may need to apply to receive it. Many programs require you to apply shortly after the tax bill is issued, so pay attention to that. And if you pay your property taxes in installments, it's worth letting your lender or servicer know so that they don't mistakenly flag a missed payment. If you ever know that you're going to miss a payment on any of these charges, the guidance from HUD is to contact your lender or servicer immediately. There are options available, including having the servicer advance the funds and establish a repayment plan, but those options require proactive communication. Ignoring the situation narrows what's available to you. Another common question is, what happens if someone falls behind on their payments? So let's talk about what the default and foreclosure process actually looks like, because most people assume it moves faster and with less recourse than it actually does. So if the loan falls into default due to unpaid property charges, the first step is to contact your lender or servicer directly. A HUD-approved housing counseling agency or an attorney can also help you understand what options remain. After a default, it may be possible to rehabilitate the loan through a repayment plan. There's also a provision called an at-risk extension, which applies to borrowers who are at least 80 years old and experiencing critical circumstances. So a long-term disability, a terminal illness, or a documented unique need to remain in the property. An at-risk extension can be renewed each year with proof of that needed. An at-risk extension can be renewed each year with proof of that need. If you receive a formal default or foreclosure notice, the most important thing is to not ignore it. Contacting the servicer immediately and seeking help from a HUD-approved housing counseling agency gives you the best chance of understanding what options are still on the table. Like many homeowners, you may be wondering how the loan actually gets paid back. The loan becomes due when the last borrower no longer occupies the home as their primary residence, whether that's from a move, a sale, or a death. If you sell the home, the proceeds go towards the outstanding loan balance. If the sale covers the full balance, the remaining equity is yours to keep. If the home sells for at least its appraised market value, but that amount doesn't fully cover the loan balance, the FHA mortgage insurance built into the HECM covers the remaining gap. That shortfall does not pass on to you or your heirs. There is also a scenario worth knowing about when the loan actually is already in default and a due and payable notice has been issued. In that situation, the home can be sold for 95% of its appraised value or the amount owed on the loan, whichever is less. And the mortgage insurance again covers any remaining balance. This is called a non-recourse feature, and it's one of the most meaningful protections in the HECM program. Neither you nor your heirs will ever owe more than the home is worth at the time of repayment. The reverse mortgage cannot become a debt that follows your family beyond the property itself. If selling isn't the preferred path, there's also an option called a deed in lieu of foreclosure, where the borrower voluntarily transfers ownership of the home to the lender to satisfy the loan and avoid a formal foreclosure process. One of the most common questions people have is, what happens to a surviving spouse? And the answer depends heavily on whether that spouse is on the loan. So if your spouse is a co-borrower, they can continue to living in the home and receive the benefits of the reverse mortgage after you pass away, as long as they continue to meet the loan requirements. This is the cleanest outcome, and it's the reason generally it makes sense for both spouses to be on the loan when possible. So if your spouse is not a co-borrower, the situation is more nuanced and the outcome depends on when the loan was originated. For loans originated on or after August 4th of 2014, HUD established protections for what's called an eligible non-borrowing spouse. To qualify, the spouse must be married to the borrower at the time the loan documents were signed and remain married until the borrower's death. They must have been identified in the loan documents as a non-borrowing spouse, and they must have lived in the home as their primary residence continuously from the time of the loan forward. So if those conditions are met, an eligible non-borrowing spouse may be able to remain in the home during a deferral period, even after the borrowing spouse passes away or moves into a healthcare facility for more than 12 consecutive months, as long as they continue to meet all the loan obligations, including paying property charges. For loans originated before August 4th of 2014, the process is called Mortgage Optional Election Assignment, or MOE assignment. In that situation, the lender or servicer can choose to either begin foreclosure proceedings or enter the MOE process. To qualify under MOE, the spouse must have been married to the borrower at the time of the loan, must have lived in the home continuously since origination, must provide their social security number or tax ID number, and must agree that they will no longer receive payments from the reverse mortgage going forward. They must also continue to meet all loan obligations. If the lender decides not to enter MOE and instead moves towards foreclosure, they must begin those proceedings within 6 months of the borrower's death. A non-borrowing spouse who is actively working to sell the property or satisfy the debt in another way can request a delay of up to 180 days. The bottom line is that if a spouse is not on the loan and the reverse mortgage is being considered, that conversations need to happen early, ideally with the HUD-approved housing counselor and an attorney who can review the specific loan documents. A close second to the spouse question is what happens to the children, specifically whether a reverse mortgage means the family loses the home entirely when the borrower passes away. It doesn't have to mean that. If heirs want to keep the home after the borrower and any eligible spouse has passed away, they have two options: repay the full loan balance or pay 95% of the home's value, whichever of those two amounts is less. So if they choose to sell instead, the sale proceeds go towards the loan balance, and if the home sells for more than what's owed, the remaining equity passes on to them. Because of the non-recourse feature, heirs are not personally responsible for any shortfall if the loan balance exceeds the home's value at the time of sale. The debt does not follow them. What heirs cannot do is simply remain in the home without addressing the loan. The conversation worth having with family now is a practical one. What do you want to happen with this property? Having that discussion before it becomes urgent removes a significant amount of pressure and confusion later. People are often surprised to learn that a reverse mortgage isn't just one payout. There are several ways to structure how the funds are accessed, and the right choice depends on what the borrower actually needs. The HECM program offers a few different options. A line of credit, where you draw only what you need and pay interest on only what you use. The available credit in a line of credit can actually grow over time, which makes it a flexible long-term tool. A monthly payout, is another option, which provides a regular stream of payments and can be combined with a line of credit for borrowers who want both consistent income and a reserve to draw from. Or a single disbursement, which provides one lump sum. And this option typically offers less money than the others, and interest accrues on the full amount from the beginning, regardless of whether it's been spent or not. So regardless of which option is chosen, there are limits on how much can be accessed in the first year of the loan. How much you can borrow overall is determined by the age of the youngest borrower or eligible non-borrowing spouse, the interest rate on the loan, and the value of the home up to HUD's maximum claim limit. So generally speaking, older borrowers, higher valued homes, and lower interest rates produce higher borrowing limits. For borrowers with an adjustable rate HECM, the principal limit can increase each month over time, and that feature does not apply to fixed rate HECMs. There's also a lesser known option called a HECM for purchase, which allows a borrower to use a reverse mortgage to buy a home rather than drawing against an existing one. With this option, the borrower brings cash or equity from a prior home to cover a significant down payment, and the reverse mortgages finances the remainder of the purchase. This can be a useful tool for someone who wants to move into a more suitable home without taking on traditional monthly mortgage payments. So is a reverse mortgage the right answer? Not for everyone, and HUD's own guidance through the CFPB is direct about that. Borrowers are encouraged to look at all available options before deciding. A home equity loan or home equity line of credit might accomplish the same goal at a lower cost, though those options typically require monthly payments and depend on income and credit. So refinancing a traditional mortgage could reduce monthly obligations without tapping equity at all. State and local programs may help with property taxes or home repair costs for older homeowners, and area agencies on aging can help connect borrowers with those programs. The timing matters too. The older a borrower is, generally the more they can access through a reverse mortgage, so taking one out early in eligibility can limit the resources available later when the need may be greater. So for borrowers in their 60s especially, waiting often produces better terms. The required HECM counseling exists for exactly this reason. Before a HECM loan can close, the borrower must meet with a HUD-approved housing counselor who specializes in reverse mortgages, someone whose job it is to make sure that the borrower understands what they're getting into and has reviewed the alternatives and is making a decision based on their full financial picture. If you have quotes from lenders, bringing them to that counseling session allows the counselor to help you compare them directly. If you're evaluating this for yourself or working through it on behalf of a parent or loved one, these are the questions that matters most before a decision is made. Can the person committing to this loan realistically afford the ongoing property charges, so taxes, insurance, maintenance, for the foreseeable future? So if that answer is uncertain, that needs to be resolved before closing. Does their spouse understand how the loan works, whether they're on it or not, and what happens to them if the borrower passes away first? Have any other family members living in the home been told that they may need to move or repay the loan if the borrower is no longer living there? Is the plan to stay in this home long term? The longer someone remains, the more this tool intends to make sense. So using a reverse mortgage to cover a short-term cash need is generally one of the more expensive ways to solve that problem. And has the family even had a basic conversation about what they want to happen with the property after the borrower is gone? These questions don't have universal answers, but working through them before moving prevents the kind of surprises that are much harder to deal with after the loan has already closed. If you or someone in your family is weighing a reverse mortgage and want to understand whether the structure and numbers actually fit the situation, use the link below to book a call with my team and we'll walk through it carefully. If you want clear, reliable explanations of mortgage programs and how they apply to real decisions, make sure to hit that subscribe button. My goal is to give you accurate information so you can make informed decisions with confidence and ultimately win with Wade. We'll see you next time.